Dear fourth grade students at the Department of Economics, welcome to the fourth recorded lecture for the Economics of Investment and Financial Markets course. Hopefully you are doing very well. The current presentation continues discussing Chapter 4 of Michigan and Aiken's 2012. The main concern of the chapter is to analyze why do interest rate changes. The current presentation is concerned with analyzing changes in equilibrium interest rate. Thus, it examines the factors that shift the demand for bonds and factors that shift the supply of bonds. Then we will turn to study two separate cases. In the first case, we analyze the impact of an increase in the expected inflation on the bond market, whereas in the second case, we investigate the influence of a business cycle expansion on the bond market. There are four factors that cause the demand curve for bonds to shift. These are wealth, the expected return on bonds relative to alternative assets, the risk of bonds relative to alternative assets, and the liquidity of bonds relative to other assets. Let's discuss them on the next slides. Variations in wealth cause the demand curve for bonds to shift either to the right or to the left. Shifting the demand curve for bonds to the right is associated with a business cycle expansion in which wealth grows. In contrast, in a recession, when income and wealth are falling, the demand for bonds falls, and therefore the demand curve shifts to the left. Moreover, the public's propensity to save affects wealth and thus affects demand for bonds. If households save more, wealth increases, causing the demand for bonds to rise and the demand curve for bonds to shift to the right. On the other hand, if people save less, wealth and the demand for bonds will fall, causing the demand curve to shift to the left. Recall that in chapter 3 we concluded that for bonds with maturities of greater than 1 year, the expected return is likely to differ significantly from the interest rate. In addition, remember that using table 3.2 in this chapter, we have found that a rise in the interest rate on a long-term bond from 10% to 20% was associated with a sharp decline in price and very large negative return. Therefore, if interest rates are anticipated to be higher in the future, then the expected return for long-term bonds will decline, causing the demand for them to decrease and eventually shifting the demand curve to the left. In contrast, if interest rates are expected to be lower in the future, then the expected return for long-term bonds will rise, causing the demand for them to increase and eventually shifting the demand curve to the right. Variations in expected returns on other assets can also shift the demand curve for bonds. Other assets include financial assets such as stocks and real assets such as houses and cars. Regarding to financial assets, suppose that people suddenly become more optimistic regarding the performance of the stock market and they expect stock prices to be higher in the future. Therefore, both expected capital gains and expected returns on stocks will rise. With the expected return on bonds unchanged, then the expected return on bonds today relative to stocks will fall, which will lower the demand for bonds and eventually shift the demand curve for bonds to the left. With regard to real assets, a change in expected inflation is likely to influence their expected returns, which affect the demand for bonds. Let me explain this point. For example, an increase in expected inflation will result in higher prices on cars and houses in the future, and hence higher nominal capital gains. Thus, it would be profitable to purchase real assets today at relatively lower prices and then selling them in the future at relatively higher prices. By doing so, I mean increasing demand on real assets today will lead to a fall in the demand for bonds, causing the demand curve for them to shift with the left. In brief, a rise in the expected rate of inflation results in lowering the expected return for bonds, causing their demand to decline and eventually the demand curve to shift to the left. Fluctuations in bond prices imply that the risk associated with the bonds increases and bonds become a less attractive asset. Therefore, the demand for bonds fall and the demand curve for them shifts to the left. In contrast, if prices of other financial assets such as stocks become more volatile, then the riskiness of these alternative assets increases compared to bonds. Thus, bonds become more attractive, which causes the demand for them to rise and eventually the demand curve for bonds to shift to the right. Increased liquidity of the bond market results in an increased demand for bonds, which causes the demand curve for bonds to shift to the right. Increased liquidity in the bond market occurs if more and more people started trading in the bond market, making it easier to turn bonds into cash quickly. On the other hand, increased liquidity of alternative assets such as stocks compared to bonds lowers the demand for bonds and thus shifted the demand curve for bonds to the left. It is important to distinguish between movements along the demand curve for bonds and a shift in the demand curve. Let's resume what is meant by a movement along the same demand curve for bonds using figure 1. As you already know from the previous lecture, each interest rate is attached to a different price for bonds. In the figure displayed here, bond prices are represented by the left axis, whereas their corresponding interest rates are represented by the right axis. At a price of $950 per bond and an interest rate of 5.3%, the quantity demanded of bonds at point A is $100 billion. Now assume that the price of the bond declined to $750 per bond. This new price is corresponding to an interest rate of 11.1%. Thus, the quantity demanded will increase to $500 billion as depicted by point E in the same demand curve. Thus, a movement along the demand curve for bonds occurs due to changes in the bond prices. Let's use figure 2 to explain the shift in demand for bonds to the right, indicating increase for demand for bonds. Remember that bond prices are represented by the left axis, whereas their corresponding interest rates are represented by the right axis. Now assume that one of the following factors has occurred. For example, the wealth increases, interest rates are expected to fall in the future, relative riskiness of bonds falls, or their relative liquidity increases. Thus, the demand for bonds at each interest rate will increase. This is demonstrated by a shift in the demand curve to the right. At each price and interest rate, a larger quantity of bonds is demanded. For example, at point B, before the shift in the demand curve, the interest rate is 11.1% and the bond is sold for a price of $900. At this point B, the quantity demanded of bonds is $200 billion. After the shift in the demand curve to the right, and at the same price for the bond and the same interest rate, the quantity demanded at point B prime is now $4,100,000,000. So the point moved from one curve to another curve. There are some factors that can cause the supply curve for bonds to shift. Among them are expected profitability of investment opportunities, expected inflation, and government spending. Let's briefly discuss these factors in the next slides. Firms are willing to borrow to finance investments if these investments are expected to be profitable. Expected profitability of investment opportunities are high during a business cycle expansion. In such a rapidly growing economy, the supply of bonds by firms increases to finance these profitable investments. Hence, the supply curve of bonds shifts to the right. On the other hand, during a recession, in which there are far fewer expected profitable investment opportunities, the supply of bonds falls and thus the supply curve of bonds shifts to the left. Recall from chapter 3 that the real cost of borrowing is more accurately measured by the real interest rate. The real interest rate equals the nominal interest rate minus the expected inflation rate. For a given interest rate and of course a corresponding bond price, when expected inflation rises, the real cost of borrowing declines. Therefore, the quantity of bonds supplied increases at any given bond price and eventually the supply curve shifts to the right. The activities of the government are likely to influence the supply of bonds in several ways. A government can issue bonds to finance government deficits. A government deficit could be defined as the gap between the government's expenditures and its revenues. When these deficits are large, the Treasury sells more bonds, and the quantity of bonds supplied at each bond price increases, and eventually the supply curve of bonds shifts to the right. On the other hand, government surpluses result in lowering the supply of bonds and thus shifting the supply curve of bonds to the left. Now let's illustrate shifts in the supply curve of bonds to the right using figure 3. Bear in mind that bond prices are measured by the left axis, whereas their corresponding interest rates are measured by the right axis. Assume that the supply for bonds has increased in response to changes in one of the following factors that are increasing the expected profitability of investment opportunities, a rise in the expected inflation, and an increase in the government deficit. Therefore, the supply of bonds at each interest rate will increase. This is shown by a shift in the supply curve to the right. At each price and the interest rate, a larger quantity of bonds is supplied. For example, at point H, before the shift in the supply curve, the interest rate is 11.1% and the bond is sold for a price of $900. At this point H, the quantity supplied of bonds is $400 billion. After the shift in the supply curve to the right and at the same price of bonds and the same interest rate, the quantity supplied of bonds at point H prime has jumped to $600 billion. We have analyzed the factors that could shift the demand for bonds and the factors that are likely to influence the supply of bonds. Now we can use our knowledge to investigate how the equilibrium interest rate can change. The best way to do this is to consider some case applications. In going through these applications, bear in your minds two things. First, when we analyze the effect of a variable change, we assume that all other variables are held constant. Second, interest rate is negatively associated with the bond price. Hence, when the equilibrium bond price rises, the equilibrium interest rate falls, and vice versa. Now, let's consider two cases. First, we will consider the impact of an increase in the expected inflation on the equilibrium interest rate, what is known as the Fisher effect. Second, we will consider the response of equilibrium interest rate to a business cycle expansion. In order to examine the effect of increase in the expected inflation rate on the equilibrium interest rate, let's start with an initial equilibrium in the bond market, where the expected inflation rate is initially at 5%. Figure 4 displayed in the current slide shows the initial equilibrium in the bond market in which the original demand curve for bonds intersects with the initial supply curve of bonds at point 1. Now assume that the expected inflation rate has doubled. How such a rise in the inflation rate affect the demand for and the supply of bonds and the equilibrium interest rate? Let's analyze these issues. If the expected inflation rises to 10%, then the expected demand in bonds relative to real assets declines for any given bond price and interest rate. Therefore, the demand curve shifts to the left. Note that the increase in the expected inflation also shifted the supply curve. In other words, at any given bond price and interest rate, the real cost of borrowing has declined, causing the quantity of bond supply to increase. Hence, the supply curve shifts to the right. As a result of the shifts in the demand and supply curves, is that the equilibrium price has moved from B1 to B2, and the market clearing equilibrium moves from point 1 to point 2, as shown in the attached figure. Remember that the interest rates move in the opposite direction from prices, that is, the bond price is negatively related to the interest rate. This means that the interest rate will rise. The shift in equilibrium from point 1 to point 2 means that interest rates have increased, as a result of the increase in the expected inflation. This result has been named the Fisher effect. In order to examine the impact of an expansionary business cycle on the equilibrium interest rates, let's use the attached figure and start our analysis by describing the initial equilibrium in the bond market. The bond market is at equilibrium at point 1, where the original demand curve for bonds intersects with the initial supply curve of bonds. At this point, the market clearing price is P1 and the market clearing interest rate is I1. Now assume that the economy witnesses a business cycle expansion. Hence, the economy expands and the amount of goods and services being produced increases, and so the national income rises. The question is now, what is the expected effect of such an expansion on interest rates? In a business cycle expansion, firms will be more willing to borrow because they are likely to have more good investment opportunities. Thus, for every bond price and interest rate, more bonds will be supplied. This is shown graphically by the supply curve shifting to the right. In addition, a business expansion also increases wealth, and therefore the demand for bonds at each price and interest rate will increase. This is shown graphically by the demand curve shifting to the right. Kindly bear in mind that we assume that the shift in the supply curve is greater than the shift in the demand curve in the current case. The new equilibrium will shift from the original intersection point of the demand and supply curve to the new intersection point labeled as point 2. In this new equilibrium point, the market clearing price declines to become B2, but the market clearing interest rate rises to I2. Remember that these two variables are negatively linked. In the previous example, we have assumed that the shift in supply of bonds is greater than the shift in demand for bonds during a business cycle expansion. Now let's assume that the shift in the demand for bonds is greater than the shift in supply of bonds. The question is how such an assumption will affect the market clearing price of bonds and the market clearing interest rate. Now it's your turn to answer this question on your own. In the current presentation, we have analyzed the factors that shift the demand for bonds and those shift the supply of bonds. The supply and demand analysis for bonds provides a framework of how interest rates are determined. This framework predicted that interest rates will change when there is a change in demand due to change in one of the following factors: income or wealth, expected returns, risk, and liquidity. In addition, this framework predicted that interest rates change when there is a change in the supply because of a change in one of the following factors. First, the attractiveness of investment opportunities. Second, the real cost of borrowing. Third, changes in government activities. Moreover, we have studied two applications to investigate the response of the bond market to an increase in the expected inflation and to a business cycle expansion. The first case shows that other things remaining the same, a rise in the expected inflation rate results in a decline in the market clearing price of bonds and an increase in the market clearing interest rate. The second case tells us that other things remaining the same. A business cycle expansion in which the supply of bonds shifts more than the demand of bonds results in a decrease in the market clearing price of bonds and a rise in the market clearing interest rate. This is the end of our lecture. Thank you.